Hello everyone. I hope you're doing good. So again, in this session, I bring up another important topic that's been very relevant for the UPSC examination. It's been continuously asked in GS paper 4, 3, 2, and 1. And I'm going to explain you what is called as taxation. See, tax when it comes to taxation, it's a pretty impressive topic out there, being relevant, especially from the P point of view and from the mains point of view out there. And it's all been there. It's all been there. So let's continue with this topic. I hope you'll get some new perspective out of it, and we are going to get certain points which you can use in your GS3 examination, in your GS2 examination one, even in your essays. And if you coming from someone whose optional is from humanities background, you can even use these platform or these what we call as content out there in your examination to fetch that extra mark out here. So I hope, see, whenever someone writes a mains, he knows that stuff. He knows a lot of stuff out there. He knows what's been doing. He has read enough out there to answer any question out there. But the competition lies all for that half mark. Competition is all for that half a mark to fetch that extra half mark from your competitor out there. How you can do that? You can do that by stating data points out there, or by drawing certain diagrams or flowcharts out there, by stating certain committees out there, or even you can use certain flowcharts in economy. It's been there out there because that will help you, because that will help you to fetch extra mark out there. That will help you to fetch extra mark out there. Okay, so let me give you a glimpse for this. Just let me give you a glimpse for this. In mains examination, pretty much everyone knows a lot of stuff out there because they have cleared prelims out there. They have enough knowledge base out there. Now the fight is for that extra mark, to gather that extra mark in each and every answer from your competitor, to additional extra mark from your competitor, because that's how you're going to land a rank, and that's how you're going to land a name in that holy PDF out there. Okay, I hope that's clear from my side. Fight is for just half an mark out there. Fight for an extra half an mark, for an extra half hour. Fight is just for an extra half hour. For extra half an hour. Not extra half an hour, but extra half mark. This is a certain thing that will land you. This is a certain thing that will land you. Your name in that holy PDF, where people see their name as an IPS, IEFS, IAS, all these stuff. So in mains, of course, the fight is for that extra mark out there. Trust me, those who are writing mains, they know enough content out there. They have cleared pre, so they have read enough out there. They know, they have decent knowledge base out there. It's all depends upon that how you gonna get fetch that extra mark out there in your mains examination. And you can do that through what we call a stating statistics out there, stats, mentioning committees out there, drawing certain flow chart out there. Okay, these are certain elements that you can use to impress the examiner out there, because you are not, see, again, no one cares about the knowledge out there. No one cares that if you write a whole essay out there, no one's going to read full essay. No one's going to read that, trust me on that. It's a most boring part. They only going to see the highlight portion of that. That's it. On the basis of that, they're gonna what you mark, they're going to mark you on the basis. So these are certain methods through which you can impress your examiner and can fetch an extra mark out there. Okay, let's move on to the topic now. Let's move on to the topic. So the topic is nothing but called a taxation, called nothing but what we called as a taxation out there. What is taxation? What is taxation? So sir, there are two types of taxation out there. 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 What's the two types of taxation called? Direct tax, direct tax, and indirect tax. Direct tax and indirect tax. When you talk about the direct tax, it's directly being borne. Of course, taxation is being directly paid by the consumer out there. Direct taxes, it's been directly borne by the consumer. It's been directly borne by the consumer. It's been indirectly borne by the consumer. First, it's being passed to the wholesaler or retailer out there. Then it's being passed to what we call as a final consumer out there. So it's an indirect burden on a consumer. It's a direct burden on a consumer. That's the basic difference between a direct taxation and indirect taxation out there. Direct burden direct burden on what we call as on which direct burden on consumers out there, final consumers. It's an indirect burden on consumers. Indirect burden on consumers out there. Okay. Indirect burden on consumers. Example of direct taxation can be seen in the form of example of direct taxation can be seen in the form of corporate income tax. You must have seen what we called as a salary slip. It's come again. It's not when you talk about a CTC, that's a cost to a company. You don't get the entire amount out of that. There is a certain amount that's been deducted to the form of what we call as a TDS. So if you have received that salary slip from your organization out there, you must have seen that there has been a certain amount that's been deducted through what we call as a TDS system, through what we call as a TDS system. That is a tax deducted at source. That is tax deducted at source. Corporate income tax, tax deducted at source. And again income tax, which is nothing but another name of what we call as TDS. Okay. So when I talk about indirect taxation, there has been a lot of indirect taxation prior to 2017. For example, if I give you certain examples for that, there would have been what we called as there was what we called as VAT, value added tax. There was what we called as excise duty. Another thing what we called as nothing but central sales tax. Central sales tax. Okay. Central sales tax, excise duty, and what we call as value added tax or VAT. Okay. They were the tax that were prior, they were there available prior to 2017. Now they has been clubbed under what we call as GST. Now they has been clubbed under what we call as GST. Clubbed. They have been clubbed under what we call as now GST. No, sir, GST is nothing but it's a major financial reform that has there in India in the last decade. It's one of the most prominent reforms that our government took, especially when you compare that in last decade. It's one of the major financial reforms that our government took. So it's nothing. It's a prominent and the most prominent financial reform if you look at the last decade out there. Prominent reform or prominent financial reform out there. Okay, these are just examples of three. There has been a 16, 17 indirect taxes that has been clubbed under what we call as a GST. That's nothing but a goods and services tax. Goods and services tax came into picture in 2017. Came into picture in 2017. This is the basic differentiation between a direct tax and an indirect tax. Again, we're gonna invest a major amount of our time in understanding what's the indirect tax out there. What's the indirect tax? And again, I'm gonna give you a brief how we calculate the corporate income tax out there, how it's been calculated. Before that, let's come into one of the most important perspectives of taxation. Important perspective of taxation out there. Important perspective of taxation out there. Important perspective of taxation out there. Now, what is this? What is this, sir? This is nothing but important perspective of taxation. Important perspective of taxation. No, so as I can say that direct taxation, direct taxation, direct taxation. It's a progressive taxation. It's considered to be a progressive one out there. It's considered to be a progressive taxation. Progressive taxation out there. It's called a progressive taxation. Why is considered to be a progressive taxation? Take an example, sir. If an Ambani or an Adani is paying heavy taxation through what we call as direct taxation or income tax out there, or if a Shah Rukh Khan or Akshay Kumar is paying too much of hefty taxation out there, that's a good for the economy because again they are earning more. They are paying taxation proportional to their income. They are paying taxation proportional to their income. They're paying taxation proportional to their income, and that's a good for the economy because it's a sort of social justice out there. A person who is earning more will pay more tax. That's how simple it is. That's how simple it is. A person who is earning more will pay more tax as compared to the person who is earning very less amount. But this perspective is not applicable. It's not applicable for what? For indirect taxation out there. It's not applicable for what we call as indirect taxation out there. Indirect taxation out there. So, if you talk about the indirect taxation out there, what it is? It is a regressive in nature, sir. It's regressive in nature. Why it's regressive in nature? Take an example. Take an example of two people out there called A and B. Called A and B. A is earning hypothetically 1,000 rupees per month. 1,000 rupees per month. B is earning 100 rupees per month. B is earning 100 rupees per month. Now, if you compare this, take an example, both went to the market to purchase a piece of bread out there. Purchase a piece of bread out there. Or a packet of bread out there. Packet of bread out there. Packet of bread. Again, take an hypothetical example that you're paying 1 rupee as a GST. 1 rupee as a GST on this. Market. market. That direct taxation is not paid by everyone out there. Of course, you need income to pay a certain amount of tax for that. But indirect taxation is being paid by each and every person out there, each and every citizen out there, each and every person that's been there in the 150 crore population out there in the India. It's being paid by everyone. That's why it is said that government is accountable to the people of India. Why? Because everyone is paying a tax. Every bloody person is paying tax out there. Every bloody person is paying a tax out there. That's why it's a responsibility of a government to be accountable to the people of India. Accountable to the people of India. Okay. Okay. It's being paid to the accountable to the people of India. Because everyone pays a tax out there. Not direct tax. It's being paid by those who has income. But indirect tax, it's being paid by every other person out there that's been there in the India. Every person, be it rich, poor out there, every bloody person that's been accounted in that 150 crore population out there, everyone pays that. That's why it is said that it's a responsibility of government to be accountable to that people of India, to the accountable to the people of India, because that they pay taxes through which government runs. So to the people of India. Now take this example. Take this example. Take this example. A person A earning 1000 rupees per month and B is earning 100 rupees per month out there. A person again, if both of them went to a market to purchase a packet of bread out there, and over that there has been GST that's been levied of 1 rupee out there. A person is paying 1 rupee over his income 1000, and a person is paying 1 over income of 100. Now this is what we call as 0.1%, and this is nothing but what we call as 1%. So a person who has a higher income, he is paying only 0.1% of his income in taxation of income. 0.1% of income in taxation. A person who has been there, who is earning rupees 100, who is just earning 100 rupees, it's paying only 1% of income. Now that's against what we called as a social justice principle. That's against what we called as a social justice principle, because a person that's been earning higher, a person that's been earning 1000 a month, he's paying only 0.1% of his income to the taxation. Whereas a person who is earning 100 rupees, or way lesser than what a person is earning 1000 rupees out there, he is paying only 0.1%. Only 0.1% is being paid by those who have higher income, and 1% is being paid by those who have a lower income out there. That's what we call it against the principle of DPSPs, directive principles of state policy, that's been mentioned under our constitution. And this is even against what we call as a social justice principle. Against social justice principle. Okay. I hope that's pretty much clear for you. I hope that's pretty much clear for you. Again, I'm going to repeat this in a very simple language out there. So taxation is being considered as a progressive and a regressive out there. When I talk about the regressive taxation or a progressive taxation, you need to look at what's been going on in the economy and the society out there. So whenever you say, okay, direct taxation is progressive in nature, it's a progressive because it's equal to what we call as a social justice. A person who is earning more will pay more tax. So, if, for example, if Shah Rukh Khan and Akshay Kumar is paying more taxes out there, or Ambani's or Adanis are paying more taxes, it's directly proportional to the income they are earning, and that's good for the economy. That's good for the economy because they are getting a chance to earn more money. That's why it's their moral responsibility and even the financial responsibility to pay taxes to the government, so they can even do welfare for the those who are at the bottom of the pyramid, those who are at the bottom of the pyramid out there. Okay. If we talk about the regressive taxation, it again comes to what we called as indirect taxation or what we called as a GST. Regressive taxation means it's against the principle of social justice that's been there. It's against the principle of social justice that's been there. It's against the principle of what we call as a DPSP, directive principle of state policies out there. Why it's regressive in nature? I've given you example for that. I've given you example for that. For example, if A and B, A is earning 1,000 rupees a month and B is earning 100 rupees a month. Both of them went to a market to purchase a packet of bread out there, and rupees 1 is divided as a GST on that packet. So if a person that is A is spending only 0.1% of his income on this, because why? Take an example. He's 1 rupee is being divided as a GST. His income is 1,000. He's paying 1 over 1,000. That is 0.1% out there. When I talk about B, his income is 100 rupees per month. He's paying 1 as a tax, 1 over 100. That is 1%. So you can clearly made a distinction between these 2 points, that a person that is earning more is paying only 0.1% of his income out there, is only paying 0.1% of his income as a GST. Whereas the person who is earning way too less is just paying 1% of his income as GST. So you can even think about that how it is regressive, how it's against the principle of TPSP, how it's against the principle of social justice, how even it's against the principle of morals and ethics. Morals and ethics. Okay. Okay. So I hope that's completely clear with you. I hope that's completely clear with you out there. So that's the one thing that I want to explain. Another is let's move on to what we call as a corporate income tax, which we said it's a direct taxation out there. It's a direct taxation out there. So how we calculate a corporate income tax? Corporate income tax out there. Corporate income tax out there. What else? Let's see. As you know, it's a direct tax. As you know, it's a direct tax out there. It's a direct tax. Tax that's been directly borne by the consumer, ultimate consumer. Directly borne by the ultimate consumer. Borne by the ultimate consumer out there. So when you talk about a corporate income tax, how it's calculated, before even going into that, you need to know what's the difference between a profit and a revenue out there. You need to know what's the difference between a profit and revenue out there. So profit and revenue. Profit and revenue out there. Profit and revenue out there. So this is profit and revenue out there. How it's calculated? See, for example, take an example of XYZ Limited. XYZ Limited. Take an example of XYZ. XYZ Limited company out there. Now, when you talk about the XYZ Limited company out there, suppose this company sells what we call as a soaps out there. This company sells soaps out there, and in a financial year of 23 and 24, they made a revenue. That means sales. Revenue means sales. What we called as a कितनी बिक्री हुई है in Hindi. Revenue is nothing but a sales out there. In a financial year of in a financial year of 23-24, it made a revenue of what we call as 10 lakh rupees for 10 lakh rupees. For what we called as a 10 lakh rupees. Revenue is for 10 lakh rupees. Revenue is for 10 lakh rupees. Now, of course, they are making soap out there. It's a soap company. So, Dove soap, all these peers, it does involve a lot of cost in this. Of course, if you make something out there as a product, it involves a certain amount of cost. That's nothing but what we call as a direct and indirect cost that's been there involved. Direct tax, raw material cost, factors of production, indirect cost, even this electricity bill, all these stuff. So there's nothing but the cost that's been involved in making up a product or an output out there. So direct plus indirect tax. Direct and indirect tax. Make it happen. Let's see. Make it happen. Let's see. Make it hypothetically as 5 lakh. As 5 lakh. Okay. Done. Now you will subtract this cost out of this revenue in order to find what's a profit. What's a profit? That's simple mathematics. Now, when you subtract this cost, not tax, sorry, cost directly from the revenue, it will turn out to be what we call as a 5 lakh rupees. Turn out to be what we call as a gross profit. Turned as to be what we call as a gross profit. What we will turn as a gross profit out there. Okay, that's a gross profit. That's a simple thing out there. Gross profit is 5 lakh. But this is not a complete profit out there. This is only a gross profit. When you talk about the gross and the net in economics, gross is simply not exactly what you take home. So, for example, if certain owner is there, owner called a person UP. UP is the owner of this company. UP is the owner of this company, and UP can't take this whole profit of 5 lakh at home. You know why? You know why? Because he has to pay a certain amount of taxation onto this. There will be some taxation that's been involved in this, and that will be levied on this gross profit out there. That's how system runs. That's how Companies Act 2013 runs. Okay. So certain amount of tax will be levied on this 5 lakh, and UP can't take this whole 5 lakh as a profit. It's not possible. So you have to carry out your business as per the Companies Act 2013. As per the Companies Act 2013. I hope that's clear with you. I hope that's completely clear with you. That's clear with you. Okay. Now that's a gross profit. But you will involve a certain amount of taxation into this, what we call as a corporate income tax. Suppose corporate income tax is flat 10% out there. 10% out there. Then this 10% will be calculated over this 5 lakh. That is the gross profit out there. Will be calculated over this 5 lakh, which is nothing but 50,000. Which is nothing but 50,000. After you will subtract this 50,000 from 5 lakh, after you will subtract what we call as a 50,000 from this 5 lakh. You will get, let me tell you, once you find a gross profit out there, then you need to apply what we called as a corporate income tax. Let's assume it's a flat 10% out there. It's a flat 10% out there, and it's been levied over this 5 lakh. That means it's a 50,000 out there. Once you deduct this 50,000 out there, it will come out to be a 4 lakh 50,000. That's your net profit. That's your net profit out there. That's your net profit out there. Once you deduct this 50,000, it will come out to be a 4 lakh 50,000 out there. That's your net profit. This is a profit. When I talk about the net profit, what's the other name of net profit? It's nothing but a PAT. That is profit after tax. PAT. PAT. That is profit after tax. That is profit after tax. Okay, that's a PAT out there. Now, this is the amount that UP can take. This is the net profit out there. But again, there has been a certain complexities that you need to understand. We need to understand. This is just a rough work out there. In order to explain this term in a layman language out there, it's just a simplistic model that I've been prepared. It's just a simplistic model that I've prepared in order to make you understand. Okay, this is how things work out there. This is how things works in a corporate and taxation. So I hope it's clear for you. I hope it's clear for you. Now, before jumping into the nitties and nitty-gritties of this, before jumping into the minute details out of it, I hope that's clear with you. If you have any doubts, you can ask about that. I'll be more than happy to satisfy that. Okay. So this is nothing but a net profit out there. What we have done, we have created a distinction between what we call as the profit and revenue. Revenue is nothing, but it's just complete sales out there. What we call as a galla kitna hua hai Hindi mein, galla. So XYZ limited companies, it's certain company that manufactures soaps and sells soaps in the market. Revenue for the financial year 23-24 is 10 lakh. Direct and indirect cost that's been involved in the company to make that soap out is 5 lakh. Gross profit will turn out to be 5 lakh. Again, you will levy certain amount of corporate income tax. That's, let's hypothetically take that as 10% out there. That is nothing but a 50,000. Subtract that 50,000 out of 5 lakh will come out to be a 4 lakh 50,000. 4 lakh 50,000 is nothing but a net profit. And another name for net profit is nothing but a PAT. That's profit after tax. I hope that's completely fine with you. I hope that's completely fine with you. I hope that's fine with you. Okay. Now let's move into the more minute details out there. How are you going to calculate corporate income tax? How are you going to calculate a corporate income tax out there? Corporate income tax. How are you going to calculate corporate income tax out there? How are you going to calculate corporate income tax out there? So again, when you talk about corporate income tax, I'll make another simplistic model for you in order to explain things more clearly. I'll present a simplistic model. Model is nothing but a very layman terms. It's gonna model simply means you're gonna explain a very complex topic in a very simplistic manner out. That's called a model. So again, I'm gonna present what we call as simplistic model. I'm gonna present what we call as a I'm gonna explain what we call as a simplistic model. What we're gonna explain a simplistic model out there. Okay. So how you calculate a corporate income tax? That's how you calculate a corporate income tax out there. How you calculate that? How you calculate a corporate income tax? Take an example. Flat rate of corporate income tax is 30%. Flat rate of corporate income tax is 30%. It's nothing but 30%. Flat is 30%. Okay. Again, sir, you don't only apply CIT. There are other taxes as well that is levied on taxation income or tax liability out there. After you apply a 30% out there, there is certain another thing called surcharge. Called surcharge. That is tax on tax. That is tax on tax. So if surcharge is, for example, is nothing, take an example of it's 1% out there. It's 1% out there. So it's a tax on tax. Tax that's been levied. That's been levied. Again, you will levy a certain amount of tax on that. You will levy a certain amount of tax on that. So if a certain amount is called, say, 30,000 or something, and it's 30% out there, you're gonna calculate a certain amount, X will come out. X will come out. It's a net profit. Again, you will apply 1% over this. You will apply 1% over this. It's a taxation. It's profit that's after taxation, but you want to apply surcharge. That's called tax on tax. So for example, it's a 1% out there. 1% of 30% is nothing but 3. So it's a 3% out there. It's 3% out there. Now effective taxation effective taxation becomes so 33%. If effective taxation becomes 33% out there, effective taxation becomes a 33% out there. Now again, you're not stop here. Don't stop over here. There's another term that you need to know what's called. It is called as what we call as cess. It is what we call as cess. Cess is a tax that's been levied on a particular thing or a very important thing out there. It's a thing. It's a that's applied on a very particular topic out there. For example, a government applies cess on what we call as Swachh Bharat, on what we call as called as Swachh Bharat, and Uchtar Shiksha Abhiyan. And Uchtar Shiksha Abhiyan. So CIS is nothing but what we call as. So CIS is what? Say for example, it's nothing but again not 1%. It's called 10%. 10% is free. It's 1%. Now 1% would be of 33%. 33% 1% is nothing but 0.33%. 0.33%. Add into this, it will come out to be a 33.33%. 33.33%. 33.33%. That's net effective taxation rate. That's net effective taxation rate. Suppose if you're thinking that, okay, I just need to pay a corporate income tax out there, that's a flat 30%, you're living in an illusion out there, because there are certain other taxes that you have to pay. There another certain amount of taxes that you have to pay in the form of what we call a surcharge or cess out there, in the form of surcharge and cess out there. I hope that's completely clear with you. I hope that's clear with you. I hope that's completely clear with you. I hope that's completely clear with you. So, do you have any doubt out there when I talk about a corporate income tax? Because again, it's a very important topic. You should know how taxation and accountancy works out there. You should know how taxation and you should know how taxation and accountancy works out there. Works out there. Okay. I hope that's completely clear with you. I hope that's completely fine with you. I hope that's completely fine with you. Okay. If you have any doubt regarding the corporate income tax, how it's been calculated, what's our charge, what says, you can ask about that. You can ask about that. I'll be more than happy to share my knowledge with you. More than happy to share my knowledge. Okay. Okay. Let's move on to the next thing. Let's move on to the next thing called indirect taxation. And in indirect taxation, first we're going to study what is VAT. If you're going to understand this, trust me, GST is easy peasy for you. It's easy peasy for you. You need to understand what was a VAT, and you will get to know what GST is. Okay. So again, indirect taxation. Indirect taxation. As I said earlier, so it's a regressive in nature. It's a regressive in nature, and it's indirectly borne by the consumer. Indirectly borne by the consumer out there, and again, it's a regressive in nature, because it's against the principle of what we call as a social justice, and it is even against the principle of what we call as a DPSP, that is the directive principles of state policy. Okay. So before jumping into the what we call as the GST, we need to understand how VAT worked prior to 2017. How VAT worked prior to 2017 out there. So VAT is nothing but what we call as value added tax. As the name symbolizes, the tax that's being levied on a value addition out there. As the name symbolizes or indicates, it's a tax that's been levied on the value addition out there. Value added tax out there. Okay. Let me explain you again. I'm going to use approach what we called as a simplistic model out there. A model is used to present or explain certain complex terms out there in a very simplistic or layman terms. Okay, so I'm going to adopt what we call as a simplistic model approach. Adopt what we called as a simplistic model approach. simplistic model approach out there. We're going to adopt what we call as simplistic model approach. Let me explain you this. Let me explain you this. Take an example. There's a vendor called A. There's a vendor called A. He produced certain amount of output. Forget about that. The value addition he did is nothing but the value of that product. So value addition he did is nothing but a value of that product. Value added. Value added. That is, take an example of 100 rupees. Now again, as the name suggests itself, that you're gonna levy a certain amount of taxation on value addition. Say for example, VAT is nothing but 10%, flat 10%. That means it will come out to be a 10. Total cost bear or total cost come out to be 110. Now this product, any product out there, for example, it's again take example of soap out there, Pear soap or any other soap, Pears and Dove, Pears and Dove. Now this being sold to a person, this being sold to a person of what we call as a vendor B, called as a vendor B. Vendor B. Again for vendor B, the cost of input. Again for vendor B, the cost of input is 110 because he has purchased from this vendor A. So the cost for this is cost of input. Is 110 rupees. Again, the vendor B added certain value addition to it, did certain amount of value addition to this, did certain amount of value addition to this. So value addition, value added of rupees, say another 200 or not, say 100. Now again, the point is vendor B in application, vendor B will pay this 100, that is 200. Value addition total 200. Apply 10% VAT over this, you will come out with 20. This person will pay directly 20 to what we call as a VAT to the government. This person will directly pay 20 to the government out there. This person will directly pay 20 to the government out there. But in return, he will say, okay, government, I've already paid a 10 rupee over this input out there. I've already paid a 10 over this. Return me this 10. Government will say, okay, you have paid me 20. You have shown me the voucher out there. That's a receipt bill out there. I'm going to refund you. I'm going to refund you this 10 rupees out there. 10 rupees out there as what we called as an input tax credit. As what we called as an input tax credit out there, as what we called as a input tax credit out there. So eventually the effective taxation that he has paid is nothing but 10. But 10, that's on only value added. That's only on it value added. I hope that's clear for you. That's VAT. Now if I talk about GST, that's a separate thing altogether. See, VAT is applicable within a state system. It's a state-wise system. It's a state-based system. It's a state-based system out there. It's a state-based system out there. But when you convert the state system in a whole nation-based system, when this method is applied in whole of a nation out there, that is considered to be a GST out there. That is considered to be a GST out there. Again, input tax credit is same. It was same earlier in the VAT as well. It was same in the GST as well. It's the same in the GST as well. Goods and Services Tax, that is 101 Constitutional Amendment Act. Okay, 101 Constitutional Amendment Act. Now, I hope that's clear. Value added tax was applied in a particular state system, while GST is applicable in the whole of nation out there. It's a national tax. GST is a national tax out there, not a state one out there. Okay, it's a national tax, not a state one out there. I hope that's completely clear with you. I hope that's completely clear with you. Okay, now that's it. That's it from my side. I hope you enjoyed this. Again, it's a bit lengthy topic. We're gonna cover this in a very detailed manner out there. We're gonna cover this in a detailed manner out there. But let's see how it operates. Let's see how it operates. Okay, let's see how it operates. So corporate income tax we have studied. We have studied what we called as all this taxation system, its perspective out there, and again the VAT and the GST out there. I hope you like that. I hope you like that. Thanks for this. Thank you.